Welcome into a very exciting edition of Market Takes. I'm your host, Dion Rabowen, reporter at the Wall Street Journal. Man, what a day, what a report. This is the kind of stuff that I live for right here. When you get a big blowout jobs report that no one is expecting. Economists predicted it was going to come in about half as hot as it did. Now the markets are moving, and I'm here to tell you exactly what's going on and why. So we're going to break all that down right here on Market Takes. We're talking about the September non-farm payrolls report, aka the jobs report for last month. This is a big one, and this could be a trend trajectory resetter. This is big because it's not at all what we had seen, it's not at all what we were expecting, and it's really not at all what the market had been pricing in going forward. So this really reinforces some things and changes some things. I'm going to break it all down in just a minute. We are going to talk about, of course, what the report said and how it compared to expectations. I'm going to give you the numbers on that. We're going to talk about what stands out in this report, what really was meaningful, dig into the report a little bit to talk to you about some numbers there. We are, of course, going to talk about the market reaction, how stocks, bonds, currencies, commodities moved as a result of this. We are seeing some big moves in the market right now. And we are going to talk about what the current market focus is on the report and how that focus could shift in the coming months based on what we saw today. We are going to look ahead to what comes next from the Fed. They have a meeting in a little over 3 weeks on the 1st of November, actually about 4 weeks from today. And then we're going to talk about what comes next from a data perspective, because even though it is backwards looking data, we are always looking forward here on Market Takes. So let's jump into it right now. What did the report show? 336,000 jobs added in September. Now, as you're looking there up on your screen, you are seeing the movement of the report each month. Now, what we had seen was a declining trend through this year. You saw a big number in January, but really aside from that, you'd seen these numbers coming in lower. Well, as you see up there on your screen, that is reversing. We are seeing higher numbers. We are seeing an acceleration, a pickup in the number of jobs added. Last month, September, 336,000 jobs added. The previous month, when you look back at if you look back at July and August, over 200,000 jobs, around 250,000 jobs added each of those months. So that is a big change from around 100,000 jobs added in June. We were down around 170,000 previously, shifting or really kind of drifting into that area where it was only around 100,000, 150,000. That was the 3-month average coming into this month. We are well above that now. We are blowing that out. And this is just a big change as you're seeing up there on your screen. And this chart really just illustrating the way the jobs market and the labor market has changed. We were kind of moving lower. Now it looks like we're picking back up again. That is big. I want to talk really quickly about revisions. We talked about this on Market Takes last month. I said, man, these revisions that we were seeing, we had seen 7 straight months of lower monthly revisions, as in every month the jobs report, the previous reports had been revised lower. So for example, last month in September, we got the August report, and the report for July and June were both revised lower. That's happened every single month up until this month. This month, not only did we see a 336,000 number for August, we actually saw July and August revised up by a combined 119,000 jobs. So the Labor Department said, well, not only were there a lot of jobs added this month, but we missed a bunch of jobs that were added in July and August. In fact, 119,000 is our estimate for how many more jobs were added in those 2 months. So this report just completely blows up that historic trend that we have seen of 7 straight negative revisions lower. I had written about this in the Wall Street Journal. You can check that out at WSJ.com. There had been a trend that we had never seen before in the history of the jobs report dating back to 1979, where we had 7 straight lower revisions. Throw that out the window right now. We had revised lower by 325,000 jobs. That's the Bureau of Labor Statistics saying, we think, based on our estimates, the U.S. economy added 325,000 fewer jobs this year than we initially reported. Now that number is 206,000 fewer based on the report that we got today. Listen, the big takeaway from all this is the economy is looking strong. maybe a little too strong, all right? And maybe a little too strong for the Federal Reserve. And if you watch market takes, or if you watch the economy, if you watch the markets, you know it is all about the Fed. Everything is all about the Fed and how they interpret the data. And what we've heard from them is they want the labor market to cool, to slow down. They want the economy to cool down so that inflation can stop rising higher. And the jobs market is one thing that they have squarely pointed to. They've said, listen, if jobs keep rising like this, if there's too much demand for labor and not enough supply of labor, that's going to push up earnings, that's going to push up wages, people are going to keep spending, that's going to keep inflation rising higher, and that's not what we want. So that's why they're raising rates. Those higher rates cutting and choking off the economy, and really it's not what businesses want. Small business especially has been hurt. This report really changes the entire trajectory of the labor market. This is a big report. The cooling job market had been kind of quelling fears that the Fed was going to have to raise rates again this year and maybe even keep rates even higher. We've heard some talk lately about 6 and 7% numbers on the 10-year Treasury, maybe the Fed raising rates that high from some reasonable people on Wall Street. Some folks at JP Morgan had talked about that. And we've seen this from some economists saying, listen, rates are going to have to go even higher because the economy is not responding the way it had been in particular. When you look at the Fed funds futures market, you can see investors are pricing in that the Fed could raise rates again in December. That has increased significantly. We've seen now 54% chance. Investors see about a 50-50 shot that there's a rate increase in December. Really in November, no one's thinking the Fed's going to raise it at its next meeting, but the expectation is they could start to set the table to raise rates in December. Now about a 50-50 chance, there was about a 2/3, a 67% chance the Fed was not going to raise rates in December prior to this report. So you see, that's changed things. This report this morning has changed things in a big way. I want to read you a quote really quickly from Brian Coulton. He's the chief economist at Fitch Ratings. He said, quote, "This strong jobs number allied with the rise in job openings in August," we'll talk about that in just a second, "and recent upward revisions to estimates of the cushion of excess household savings point to upside risks to the near-term U.S. economic outlook." What are upside risks? That's the risk that the economy is too hot, that it's growing too quickly, and that inflation is going to pick back up, and that's a risk. Get back to Brian's statement. He says, quote, "The labor market is not going to cool with job growth continuing at this rapid pace. This will keep upward pressure on wages, making it more likely that the Fed has further to go in raising interest rates." All right there from Brian Coulton, chief economist at Fitch Ratings. So let's talk about really quickly, what's the big standout number? It's the headline number. 336,000 jobs added last month. That is big. Not only that though, 119,000 more jobs added for July and August. Those are the big numbers here. Most surprising thing in this report though really was average hourly earnings not picking up. So that's something for the Fed to really chew on and think about. The Fed has said the reason they're worried about the job market being too hot, about too many people getting jobs, about too many people looking for jobs, is they're saying, well, that's going to keep pressure on inflation. That's going to keep folks demanding higher wages. That's going to keep companies having to pay up for new employees. Once people got that money in their pocket, they want to go spend, and companies then raise prices. People keep buying because they've got that money in their pocket from their new higher paying job, and that pushes up inflation. That's what the Fed talks about. So what we did not see though was that average hourly earnings number rise. That only rose 0.2% this month. It's down about it's up 4.2% year over year, 0.2% month over month. All that means is we are sticking steady at that pace, a little over 4%. It was about 4.5% when we saw this report in June, now down to 4.2%. So we're seeing average hourly earnings, or what people are getting, the raises they're getting, or how much wages are picking up, sticking above 4%, not falling below, which is kind of what the Fed wants to see. They won't say it explicitly, but Powell and company have hinted at that. But it's not coming down there, but it's not picking up. It's not rising, even as we saw a big number, over 336,000 jobs added this month. So employers seemingly are able to hire without wages jumping that much. Very interesting. Let's put a chart up here on your screen right now that shows you what the Fed is talking about. So when the Fed talks about there's too much pressure in the labor market, this is what they're talking about. You see the number of job openings there. Up until 2018, there had never been more job openings than there were unemployed people. Well, that changed, and then when you see there in 2020, the pandemic happens, it goes lower, and then since then it's pulled back. You've seen many more job openings than there are unemployed people. And you see the trajectory is moving down. You're seeing job openings decline up until this past month when they picked up again over 9 million. Number of unemployed people had been picking up. That came down again a little bit this month. So we're seeing the labor market move in the opposite of the way the Fed wants. And this chart right here just illustrates that. The way that we had seen those numbers kind of coming together, now they're breaking apart just a little bit, moving the opposite of the way the Fed wants them to. Some had kind of written off this last jobs report that we got on Tuesday as an aberration, as, oh, that's just, it's noisy data, blah, blah, blah. Well, actually, this JOLTS report may have been showing the trend as we saw a big increase in the number of job openings, a big increase in the number of people looking for workers. That may actually be telling of what the trend is. If the jobs report today, the data we got is correct, that aligns with the JOLTS report actually. And if jobs rose more than we thought in July and August, the economy may be hotter than we thought. And really, we may have to readjust and reevaluate our positions. Us here who watch the markets, people who are investing in the markets, buying and selling, doing all those things, we may be looking at a big reset. The Fed meeting on November 1st will be big. We are going to see if they start to set the table for a rate increase in December. That could change the landscape again. Listen, this was a big report, and it's going to have a lot of those folks at the Fed talking about what comes next. I spoke with San Francisco Fed President Mary Daly just yesterday. We had a great conversation about a lot of things about how she's evaluating the labor market, what's happening in financial markets, what she's seeing out there. And one of the things that she says the Fed needs optionality. She's historically known as a bit of a dove, someone who likes to keep rates low. And she was saying, well, we've got to step back and we've got to see what the economy does. The economy is adding 336,000 jobs a month. That may mean that they may have to hike rates. Mary Daly is a voter next year on the Fed's committee. So keep that in mind. We'll talk more about that in just a minute. Let's talk about, though, the market reaction. I want to put a chart up here on your screen, and we'll just look at what's going on in the market. So you see right there on your screen, the Dow, the S&P, the NASDAQ, all negative, all in the red for the day, and they've been moving lower as investors have kind of gotten a chance to really digest the report. And nothing in the report says that this is good for stocks. The equity market's heading lower and on our way to a fifth straight week of lower prices on the stock market. I want to talk about bonds really quickly because, if you know me, I love bonds because that's where the real action is. That's what really tells us what's going on in the economy. And we see here the 2-year, which is most correlated with what folks expect from the Federal Reserve. That only rose about 5 basis points. So when you see what's going on over here, you see this big spike after the report came out, jumping all the way up here to about 5.2% on the 2-year, but then coming back down as folks digested. You say, okay, maybe the Fed's not going to move immediately. We don't need to reprice the 2-year, but look up here at the 10-year note, right? You see that big spike, but then it holds up there and you see rates climbing higher. That's expectations for the longer term economy. And what you're seeing here is a move up in longer dated yields. So the 2-year, the 3-year, the 1-year, those all moved up a little bit. You see 4, 5, 6 basis points right here, the change a little bit. And you see it kind of coming off. But then when you look at the 5-year, you see that sticking around. The 7-year, you see that big rise sticking around. The 10-year, you see it sticking around. And then the 30-year, same thing, right? Those yields jump up and they stay high. Let's take a look at currencies. What you're seeing in the euro, that moves against the dollar. You're seeing the dollar rise, the value of the euro decline, and you're seeing it move in a big way. Let's check out the US dollar index. So the dollar tracking higher, moving in a big way right after that jobs report and jumping up higher. And really all these things just illustrating the way the market is responding and reacting to this jobs report. The market expecting longer term growth, longer term rates to stay higher, more inflation, pushing those expectations out into the long term. And that really is what we're seeing as a reaction from this jobs report. Maybe the U.S. economy stays hot for longer. That forces the Fed to push rates up for higher for longer. And that is going to increase the yield on bonds, which is going to lower their price. As we know, when yields rise, prices fall if you watch market takes, which, all you do. So I appreciate you. So listen, let's talk about really quickly the current market focus on the jobs report. As we said, it's all about the Fed, all about the Federal Reserve. This report suggests investors may have underpriced the higher for longer theme. Maybe rates could be even higher for even longer. So that really, to me, is the big takeaway from this report. It's not locked in. We're not certain. This is one report. You don't want to throw out your whole economic thesis based on one report. But this report does certainly suggest the Fed could raise rates again this year. I think a lot of people had priced that out. That could happen. Likely not in November, but it could be on the table for December. But again, we were thinking higher for longer based on the Fed meeting just a couple weeks ago. This report may suggest even higher for even longer, and that's the big theme. For the Fed, the biggest takeaway from this report is, like I said, they may have to swing into action this year. I think you saw, and actually, you know what, let's throw this chart right up here on your screen right now. And we're talking about the dot plot, right? Now, this may not make a lot of sense if you don't know what you're looking at, but I'm going to walk you through right here. So this is where the Federal Reserve expects rates to be at the end of a particular year. So you see there on your left, 2023. Well, right now, rates are about 5.25%. They're in that range between 5 and 5.25%. There are 7 dots there. And that's 7 people who expect the Fed is not going to raise rates again this year. 7 voters on the Fed's committee, or 7 members of the committee. There are not 19 voters, there are 19 members, and there are 14 voters. So not all these people actually get to vote on policy, but all these people have a say. They're at the meetings, they get to express their opinions. There are 12 people who think there will need to be one more rate increase this year. Now, this was in September before we got this report. You can imagine those 12 people, well, they've now got a big thing that they can hold up, a big number. They can say, look at this data. We need to raise rates again this year. The Fed's bias, according to this dot plot that you see, was already to raise rates once more this year. The market didn't believe them. This report may get the market to believe them. And if you look at 2024, most folks on the Fed expect to lower rates, for rates to decline, but that's much higher than where the Fed had expected rates to be at their meeting in June. So the Fed had already raised its expectations for where rates would be at the end of this year and at the end of next year, and they raised them significantly before we got this report. So this chart here, the dot plot, just illustrating where the Fed stood before we got today's big jobs number, and now you can imagine that there's even more folks on the side of, well, we might need to raise rates again, because there were already a lot of numbers, or a lot of people on the Fed's committee who were saying we need to raise rates again this year. Likely they've got a big piece of data in their pocket to back what they were saying, and they may get more people on their side after today's jobs report. Let's wrap it up. Let's get to the end here. The biggest takeaway from this, like I said, we were talking about higher for longer. We may be talking about even higher for even longer. Here's what we have to look forward to next. The next data reports, we've got the Employment Trends Index that's out on Monday. That is going to be big. It's not usually very followed, but you're going to want to watch that. That could really move the market in a big way because of this big blowout jobs number that we got. People are going to want to know, well, what happened in the second quarter? What's going on in previous months? Why is the Labor Department revising the jobs report up by about 120,000 jobs? That report could move markets, so watch that. You've also got the NFIB Small Business Optimism Report on Monday. We get the Fed minutes out on Wednesday. We'll get to find out what the Fed talked about at their previous meeting. That could also be a market mover. One thing I will tell you will definitely be a market mover is the CPI Consumer Price Index Report. That comes out Thursday, October 12th. We will be right here on Market Takes. We hope you'll join us because I think that's going to be very watched. Markets are going to be very keyed into that, and you could see some big market moves. So make sure you're with us here on Market Takes Thursday, October 12th. We'll be breaking down everything and all things with the CPI report then. Listen, one last thing before we get out of here. Want to plug my new podcast, Take on the Week. For more on what may move the markets, check out my podcast, WSJ's Take on the Week. We cut through the noise to explain the major business and financial news that may move the markets, all so you can make smarter investing decisions. Subscribe wherever you get your podcast. You can check it out on WSJ.com. All the podcast providers, check it out there. We'll be breaking all this stuff down. I am Dion Rabowen, reporter at the Wall Street Journal. Thank you all so much for being with us. We will be back, and we hope you'll join us when we do it again next time.